at 4,400, after that kind of rally, even the most dedicated gold bull was probably saying, I think I'll pull back and wait for a week or two. They are not buying because they think, wow, this is a great time to buy gold. Look at the chart. There's a cup and handle. There's a this, there's a that. And it might, we might be able to get a 20% move in the next 12 months. They're buying for insurance. They're buying for defensive reasons. They are not, and we don't need to go into all the reasons. We know why those different people are buying. But the point is they're not buying for the traditional economic reasons that people have bought gold.
Adrianday explained that the current surge in gold buying isn't about speculation or technical setups. It's about protection. When gold reached $4,400, even the most devoted bulls paused, expecting a short-term pullback. Yet demand remains strong, not because investors are chasing profits, but because they're seeking insurance. Day emphasized that today's gold buyers aren't studying chart patterns or hunting for a 20% gain. They're safeguarding against instability, monetary, geopolitical, and systemic. The motivation has shifted from opportunity to preservation, as more investors view gold as the last reliable hedge in a world of eroding currencies and fragile confidence. This isn't greed-driven buying, and it's survival-driven allocation. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
If you look at gold itself, look at gold and look at its performance. There's no question in the last 2 months, gold had gone up too far, too fast. It had been, I like to say it was overbought but underowned, but it was clearly overbought. It had gone up too far, too fast. But look at a long-term graph and look at it in a log term. Look at it in a percentage term. This rally over the last year and a half in gold is less than the 2010-11 rally, and it is less than the 1979-1980 rally. So this rally, however dramatic it seems to us now, and of course going up every single day for a month and hitting new milestones every week, made it seem like it was unprecedented. It was not unprecedented. In terms of percentage move, this is less than 79.80 and less than 2010-11. So that's the first thing I'd say. The second thing I'd say is that the gold stocks, although they're up over 100% year to date, they were up over 100% year to date, they still had not exhibited the traditional leverage that gold stocks exhibit to gold. And they were still fundamentally cheap if you look at price to earnings, price to cash flow, price to NAV. Because of course, as the price of gold moves up, then the margins expand because the costs are not going up as much. You've got all-in sustaining costs for the industry somewhere around 2,200. Those are pretty astonishing margins. And of course, some companies have even greater margins. And so the margins were expanding. And with the margin expanding, that means your cash flow is increasing, which means your price to cash flow multiple is not going up as much as the price of gold would make you think. So the gold stocks were still cheap. A bull move dies of exhaustion. When there's no more people willing to pay those higher prices, not willing to pay those higher prices at that time. So there doesn't always have to be a reason. I mean, if you want what happened in the last 2 months, well, it wasn't a huge increase in central bank buying. We know that the last month we've got numbers for, or the last month we've got comprehensive numbers for, are August. And in August, central bank buying was up on June. There was a pause in a couple of months, or a slowdown in a couple of months before that. But that's August. So did the central banks suddenly resume buying in September, October? I don't know. I have no reason to think they did. There's nothing to suggest they did. If you look at individual banks that have reported, there's not a huge spike. There was a huge spike in Chinese non-official buying. That became a little bit of a mania. So a huge increase there, and you can see that by the premiums on the Shanghai Exchange, by the lines outside jewelry shops, by the pickup in import, which come through Hong Kong. So you've got numbers. You don't have numbers on how many ounces were bought by, Chinese consumers, but you do have indications that suggest that there was a huge spike from that source. I mean, clearly it had gone too far too fast, and it was just waiting for a pause. And again, the pause, when you think about it, wasn't caused by anything. I mean, we had the Gaza peace deal, which was 2 weeks before gold peaked, and it was actually beginning to look as though it might fall apart the day the gold topped. You had China and Trump at it that week, so there was no reason for it to decline because of now it's changed. That scenario has changed. But so what I'm saying is I don't think there were any fundamental reasons why gold went up the way it did in September, October. And I don't think there were any fundamental reasons why it stopped going up on the 19th or 21st or whatever the date was.
When we look at gold's performance over the last year and a half, it's easy to think the move has been extraordinary sided, but in historical context, it's not. This rally, while sharp and emotional, is minor in percentage terms than both the 1979 and 1980 and 2010 and 2011 surges. Gold went too far, too fast, as Adrianday puts it. Overbought, but still deeply underowned. Gold stocks, meanwhile, have risen more than 100% year to date, yet remain fundamentally cheap with strong margins and expanding cash flow. The recent pullback isn't driven by collapsing fundamentals or fading central bank demand, but by natural exhaustion in a powerful bull phase. Markets breathe, consolidate, and reset before the next leg higher. And this one is no exception. Let's get into the interview.
So we know who's been buying gold. It's the central banks. It's the non-official Chinese. It's wealthy families in the Middle East concerned about, fiscal deficits around the world and instability. And those buyers are all of those buyers I just mentioned, but particularly the central banks and the wealthy Middle Eastern individuals and families are, if not price agnostic, they're certainly price inelastic. They are not buying because they think, wow, this is a great time to buy gold. Look at the chart. There's a cup and handle. There's a this, there's a that. And it might, we might be able to get a 20% move in the next 12 months. They're buying for insurance. They're buying for defensive reasons. They are not, and we don't need to go into all the reasons. We know why those different people are buying. But the point is they're not buying for the traditional economic reasons that people have bought gold. Now, North American investors, because we've never had that experience of actually needing gold, the experience that China's had when the people fled to Hong Kong, or the experience that Germans had after the Weimar Republic, etc., etc. Because of that, North Americans typically don't buy gold as a defensive asset. I mean, first of all, I think people should have some gold that is more or less permanent as a defensive position, as an offset as a hedge on the rest of the portfolio and so on. So we're not talking about that permanent insurance position. If you've got gold as an investment, depending on when you bought it, of course, you have done better than you could rationally expect to do from an inert substance that doesn't pay a dividend, right?
Yeah.
As its detractors keep telling us. And I think it is definitely, so what I would say is definitely this will be a good time to shift, meaning to sell some of the gold bullion or gold ETFs and move it into the miners that are on a historical basis undervalued relative to gold. So the gold stocks are undervalued relative to gold. Now, you could go further and say, if you look at other commodities like copper, natural gas, oil, you could argue that those are even more undervalued relative to gold because they've hardly, even though copper's basically at a high, but I mean, you could pick a handful of copper stocks, and even though they've gone up, they are still fundamentally undervalued relative to gold. And that's even more true for oil and gas, which of course has just been, it's been anathema to own those. But to answer your question, I certainly think right now would be a good time to trim the gold, take some profits. Of course, there's tax considerations. I'm not getting into that. To trim the gold and to buy the gold stocks. Some of the gold stocks are still very, very under. If you're a miner producing gold, then the gold price is the number one determinant of how well your company does. No question about, just as if everybody suddenly stopped eating and living off air, Nestle would no longer be a very good company to own. So there's no question that the price of gold the price of gold can forgive a lot of sins, and in a bad market, there's only so much any company can do. But I don't think you can. I honestly don't think you can say that it's all. No, I don't think you can say that it's all a gold price at all. I mean, you look at a company like Agnico, which is, obviously the gold standard. But you look at a company like Agnico keeping costs, well, most of the companies, but keeping costs well under control, a little bit up in the last quarter, but down in the quarter before. Very, very disciplined. No, I don't think you can say it's all a gold price. But clearly, if gold goes back to 2000, all of the gold stocks are going to.
The latest surge in gold buying, as Adrian explains, isn't speculative. It's strategic. The real buyers today are central banks, wealthy Middle Eastern families, and non-official Chinese entities, all of which acquire gold not for quick profits, but for insurance and stability. They're price inelastic, unconcerned with short-term charts or technical patterns. Meanwhile, North American investors, largely inexperienced with monetary crises, still view gold as an afterthought rather than a necessity. Day believes this moment offers a brilliant rotation opportunity. Trim profits from gold bullion and reposition into undervalued miners, which remain historically cheap relative to bullion. These producers, with tight cost control and expanding margins, stand to outperform if gold stabilizes above current levels. The shift from passive protection to strategic positioning could define the next leg of this precious metal cycle. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.